is I constantly have to check my psychology to remember, the long tried and true advice from Buffett and everybody else, the dollar cost averaging, which not a lot of people talk about in private equity. A lot of people talk about it in the stock market.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why? Hi everyone, I'm Jason Balara, and this is the Know Your Why podcast. Today I'm here with Travis Watts for the second time. I'm really excited. It's been a couple years. Amazing how time flies. For those of you who don't know him, which is probably a small number, Travis is a full-time limited partner investor and director of investor development at Ashcroft Capital. So Travis was on the show a couple of years ago. Thank you so much for coming back. I really am excited to talk to you again. The probably entire landscape of what we talked about then has changed. So it'll be really great to catch up and kind of get your perspective at this point. Thank you very much.
Definitely, Jason. Thanks for having me back on the show. Yeah, I wanted to provide your audience with an entirely new perspective and some topics to talk about, much of which we didn't get to cover before. But more importantly, to your point, the last 2 years have been obviously unprecedented in many ways. Lots changed in the space. So I just want to give everybody kind of a fresh glimpse of what I'm looking at as a limited partner, what we're looking at as a company, syndicating deals in 2024, kind of what the opportunities are and how you can benefit from it.
Yeah, absolutely. I think it'll be really valuable to listeners, and you have a different perspective, I think, than a lot. So, Travis, can you remind people just a little bit about your background so they have a frame of reference? Certainly, they should go back and listen to the first interview, but just a quick background, and then we'll just kind of talk about where things have gone for you in the last couple of years.
Sure. Yeah, happy to. So I started flipping single family homes is how I got started. In 2009 is when I bought my first property. Thought that was going to kind of be the path to wealth until I couldn't scale it anymore. And it just became a full-time job. And I already had a full-time job back then working in oil and gas. So I made a transition in 2015 after listening to a couple mentors that have been very successful in private equity and more importantly, multifamily syndications specifically, and kind of just started to adopt their philosophy more or less to be a full-time hands-off investor, to be a passive investor, to invest in other people's deals, let other people manage everything. And so ever since I've been, full-time limited partner. I'm an advocate for passive income and cash flow. And I work with Joe Fairless at Ashcroft Capital, done a multitude of roles with the company over the last 5 years. But right now I work on investor development. And so it's a confusing title to some, but it's it mainly is investor education to simplify the title. And so I do a lot of property tours and videos and podcasts and webinars, and I write a lot of articles and blogs for our newsletters and websites. But my passion at the end of all of that is just simply helping other people understand what this stuff is, how it can benefit you, because as you well know, it's not well marketed out there, or I should say it's not mass marketed out there, because Wall Street kind of has a grasp on that and always has. So that's my passion.
Yeah. The marketing is certainly lacking, and it's just unfortunately the availability of real estate syndication, passive investing is it's just held back a lot by some of the SEC regulations, and in a way I understand why they do it, but I also don't think it should be a different regulations for that than it is for the stock market, and yet it is. So so I think a lot of people know things have changed in the real estate landscape over the last couple of years. I think mainstream media knows mostly about interest rates. That's what gets probably talked about the most.
Sure.
But I wondered if you would kind of maybe talk about your experiences over the last couple of years for your from your perspective and what you've seen, and you mentioned kind of we'll get to also, kind of what you're doing now as a company and as a with investor development. But what do you maybe give people your perspective of what's going on right now?
Yeah, let me try to simplify it in really three topics to describe kind of what's going on in 24. So, number one, to your point, everybody knows interest rates have gone up at a crazy aggressive level, the fastest in US history, fastest slash most aggressive in US history. And so, what that's done to commercial real estate, and I don't think a lot of people really realize this that are not in the syndication world, the difference between commercial and single family, one differentiator, a major one, is the type of debt that you typically put on a deal. So when you're out there buying a home for yourself, you're going to go get a 30-year fixed rate mortgage, maybe a 15, and it's fixed. So something like 70% of homeowners right now nationwide have a low interest rate that they locked in before this interest rate cycle, and it's really not affecting them. Home prices actually have continued going up despite higher rates, and their mortgage payments haven't changed, assuming they have a fixed rate loan. So there's not really a crisis happening right there, besides being unaffordable for new buyers or anyone looking
Right.
to sell and rebuy a home. In commercial, you're often getting adjustable loans, floating rate loans, bridge debt, which could be anywhere from 6 months to 3 years. The typical debt length is about 5 years, in fact. So what's happening right now, the opportunity slash crisis is these higher rates have put a lot of these deals in jeopardy of being able to distribute cash flow, and their valuations are 20 to 30% down depending on the market and the deal that we're talking about. So it's not a good time to refinance, it's not a good time to sell, and there's a lot of distress out there in the market. So that's kind of the gloom side of the equation. The opportunity is that cap rates have increased alongside these interest rates. Now, cap rates are a primary valuation driver to commercial real estate. So the higher the cap rate is, the lower the potential purchase price is. So right now, if you look at forecast and data by, let's say, CBRE, CoStar, there's Marcus and Millichap, there's a lot of these forecasts going on that are suggesting we may be bottoming out or have already bottomed out in this commercial real estate cycle. So what that means is for a limited amount of time, and this has already debatably started, months ago, there's an opportunity to buy at a significant discount that, we haven't seen for a decade plus in the commercial real estate space. In fact, the Great Recession was the last comparable valuation segment here. So what you're starting to see now, everybody listening, is Blackstone's putting in billions of dollars of multifamily and single family investments. You've got JP Morgan Chase. You've got these huge mega names. You've got Jeff Bezos backing a real estate startup company that's buying thousands of homes nationwide. The big money is jumping in to scoop up the deals. Okay. But a lot of retail investors, mostly due to psychology, in my opinion, are still on the sidelines.
Mm-hmm.
Let's wait and see. It's scary. It's an election year. My past deals aren't performing the way I hope, so I'm not going to do any new ones. There's a lot of that kind of mentality happening. The problem is it's literally the most amazing time to get into commercial real estate this year. So something to
Yep.
think about with dollar cost averaging, buying the dip, that kind of stuff. Number two is supply and demand. Okay, so to use one metric, the National Multifamily Housing Council says we need to build 4.3 million more apartment units by 2035 to meet the demand of renters. Okay, so we're undersupplied, even though we got a lot of new supply coming to market this year. But caveat that with the fact that new permits for new construction are down 40 to 50% in most markets nationwide. So because rates went up and labor went up and materials went up so fast, so quickly, builders have largely pulled out of starting new projects that typically take 3 years plus to build. And so what's that going to do if you're getting into a deal now in 5 years, right? We're going to have an even further problem with lack of supply, and you're going to be an investor in something pre-existing and cash flowing, and that's really going to help with valuations there. Last thing I would say is, back to the single family argument here, people buying a home today or considering it, whether a first time home buyer or somebody moving, is we've never had a larger gap in US history between a new mortgage rate and apartment rents nationwide. It's nearly $1,000 per month differential right now. One of the worst times to become a homeowner right now. So making the case again for renting. And so those are three things just to think about if you're considering making investments this year in this type of environment. And by the way, the forecast, if you're not don't know this, is forecasted to come down in the coming years. Nobody knows exactly when the Fed's going to start to cut, how much they're going to cut, the reasons they're going to cut. Nobody knows that stuff. But the forecast from nearly every analyst out there is rates come down in the next 2-3 years. So again, if you're getting into a deal with a 5-year hold, what does that mean for being able to potentially refinance? What does that mean for potentially having valuations go up? What does that mean for potentially exiting early from a deal like we used to in the past, where we would say 5 years and sell in 3? Something to think about.
Yeah, no, all of those are great points, and I think one of the things that always you can look at those big companies like Blackstone. I mean, they've been doing it for a long time, and they do it at large scale. The people I worry about, and you mentioned this, is kind of the retail investors and the psychology around it all. And yeah, a lot of people want to sit on the sidelines because they had a deal that isn't doing what they thought it was going to do, right?
Right.
We had this amazing time where people were, able to double their money in sometimes 18 months, 2 years, 3 years, instead of 5 to 7 years. And so people began to expect that, and then that changed very, very quickly. And so the people that got in because they thought that's what was going to happen are now reluctant to sort of reinvest in new deals. But to your point, this is actually the better time to get in. And what I hate is that some people that are sitting on the sidelines are not investing because of their bad experience. But like, if you stop, now you've only had the bad experience, right? You mentioned sort of that
Right.
dollar cost averaging, but it's like, if you invest one time and it doesn't go well, then that's all you've ever experienced in terms of investing. And you do have to look at it as, sort of a long term. Some are going to do well, some are going to not do as well. And it's just kind of recognizing that. And I think this is another, I guess, when you correlate this to the stock market, there's trillions of dollars in retirement accounts, right? And people aren't stopping putting money in their retirement account because they don't do well sometimes. Like, they know they can't touch that money for a long time, and so they kind of can, I guess, put it out of their head. But it's really an interesting, sort of study in psychology.
Fidelity, I used to work at Fidelity years ago. They ran a study of the best performing accounts and who these people were that had accounts at Fidelity. They found out it was dead people because they just left it alone.
Yep.
And, that is a great point that you bring up. And it, kind of makes me think the next thing I want to have your audience know is kind of, I have a unique perspective in that, I've done over 50 of these deals. I've lost count of the number, being a limited partner in these syndications. And I feel for those who just got in the space in 2021, did their first deal,
Right.
or worse yet, sold a company or business and put everything into, one sector or segment or one deal, because the psychology does make sense, right? Like what you said earlier, if you're 18 years old, no experience, and I give you $1,000 and I say, hey, best strategy is the stock market, go put it in the index, right? And then the stock market collapses 40% next year, you're going to have the same response. You're going to be like, screw this. This is stupid. This is the worst investment ever. I'm not investing anymore. You're just
Right.
going to have a very negative outlook. But having
Yeah.
gone through 50 of these deals, I can tell you a couple things. And the first thing is I constantly have to check my psychology to remember the long tried and true advice from Buffett and everybody else, the dollar cost averaging, which not a lot of people talk about in private equity. A lot of people talk about it in the stock market. And you gave
Mm-hmm.
a perfect example there with a 401k or something, or an IRA. People are consistently year over year just putting a little in, a little more in, and you're not trying to time the market. You're going to buy in the up years, you're going to buy in the down years, you're going to buy in the middle years, but you're going to get an average overall return. And I've been a huge advocate for that. It's not easy to do, it's easy to say, but I constantly check myself on that. And also the fact that risk goes up when prices go up. and risk comes down when prices come down. So just that simple realization that
Mhm.
if you're investing now, you're taking a lot less risk potentially than you were in 2021, for example.
Right.
And the second thing is, I've never been a fan of just counting on appreciation. Well, I can't say never, because when I first started flipping homes, it was purely an appreciation game. But it changed after doing so many of them. What I started to realize when I was looking at my spreadsheets and my numbers was, if the market hadn't been going up as strong as it had, I was out in Colorado in 2009, 10, 11, 12, 13. I mean, it was rocking and rolling. We were seeing double digit returns by doing nothing. And I realized I would have been losing money on half these deals. I wasn't a good flipper.
Right.
And
Right.
so just purely speculating on appreciation is not a good strategy. Cash flow to me is the ultimate strategy. And so, surprisingly, I'll share this with your audience in full transparency. With all these commercial deals that I've done and that I still have in my portfolio right now, the floating rate debt from 2020 and 21 and maybe even 2019, most of those have had to pause or reduce distributions, in some cases even capital calls I've experienced. All the fixed rate debt is still cash flowing today. I've got some of these deals bought 2017, we're still holding 17% a year cash flow, stuff like that. So
Yep.
something to think about is, with the right structuring, and I'm sure we're all going to pivot a little bit given what's happened the last 2 years. Consider longer term debt, consider some fixed rate stuff. But there's also the case to be made now for floating rate again. If rates are going to come down, then why fix
Yep.
it at the highest possible rate? But anyway, I digress. But I think in conclusion, my last lesson to share here, 50 plus deals, is just diversify. Again, no one wants to be that person in 21 to put all their money in whatever stock market, or,
Right.
imagine you invested heavily in the office sector. That's the worst performing commercial real estate class right now this year, or at least last year. So, yeah, you can find cash flow in a lot of different asset types. And so, at any given time in my portfolio, I've got a deal over here that's suffering, and I've got a deal over here outperforming. And going into those two deals on day one, I couldn't have told you which one was going to do better. So don't try.
Yeah. Yeah.
Just
No.
diversify.
Right. I mean, we make all the projections and it's just, you just never know nobody knew what was going to happen with interest rates, but it's not the only thing, right? It's not the only factor. There are local market
Sure.
factors. There are
Yep.
operational factors. I mean, there's a million different things that can impact performance. And I think, I know one of the things that you guys are really focused on is, sort of operational efficiencies and kind of how to, you said we don't want to rely on appreciation. And I think that the traditional version of a value add strategy in theory should not have relied on appreciation. But what you mentioned about, you being a house flipper, a lot of people went in with a value add strategy, maybe didn't manage it perfectly, but were helped out by, sort of the up market. Now on the flip side of that, we have to be, the only way to go forward is to kind of really dial in those operations. And I know there's some things that you do specifically in regard to that to help. I wondered if you would talk about that a little bit.
Sure. Yeah, happy to. So a couple things. I'll start with just kind of the broad picture of vertical integration. So managing your own properties. And then at Ashcroft, we've taken it a step further, where we have construction management in-house as well. We waited until we hit scale as a firm to go vertically integrated. That's always a choice on day one. You might want to manage your own properties right out of the gate. We decided not to, but we started to outpace our third parties' capacity, both in the construction side and the property management side. At the time we went vertically integrated, we were over $1 billion in assets under management, and we were comprising 40% of our property managers' portfolio, even though they were managing lots of other groups. So we were just moving too fast. And so we faced some challenges, and I'll start with those. And the first was, we had a lack in alignment of interest, okay, a lack of attention to our portfolio specifically, right? No one cares more about your own deal than you. And
Yeah.
then talent was lacking in who this third party was hiring. And we had very little control over who they hired and how they trained their employees. And then they had inefficient infrastructure. I'll just say that in simplicity, meaning our demands were growing, we needed more and more, and they didn't have the infrastructure to keep up. So, if you're the owner and the manager, then you're directly impacted by better performance. That was kind of the overarching theme of why we decided to pull the trigger on this. So, three benefits. We've got an amazing culture at Birchstone Residential and Construction, which is our own in-house property management construction firm. Improved KPIs across the board, including vacancy, collections, spending reduction, stuff like that, and just more accountability across the board. Now, one other thing I'll talk about here on the topic of vertical integration is how we ended up figuring out how to save 30% on material costs, not on every single material, but on the bulk of them. And so we launched our own in-house procurement process. We call it Shore Home. And Frank Rosser, our president, CEO, and Joe Fairless is co-founder. He was going overseas when COVID happened, slightly after, and supply chain issues were popping up, and inflation was starting to creep up, and started visiting these overseas manufacturing hubs to see if they could start to create custom product for us, and we could buy directly from manufacturers to cut down on the supply chain issues, obviously, but also to save costs. So our process today is that we get custom designed materials for our properties. And when I say that, I'm talking about ceiling fans, light fixtures, cabinet pulls, door handles, shower rods, this kind of stuff that go into nearly every single unit that we renovate. Custom to whatever the latest trends are. When you go to Home Depot or Lowe's or some local outlet, if there's something trending, let's say it's a matte black finish, you're often going to see a markup on those particular items because they're in the highest demand. We don't pay any additional markup to have it A, custom designed for us, but B, whatever the latest colors and finishes are. So we buy from the manufacturer, they ship on a boat, a cargo boat to Texas. They drive our materials up to our warehouses in Dallas, Texas. We have in our warehouses, we're assembling these ready to go kits that we use to renovate our units. And that includes all those materials that I was talking about. And then we've got, custom made dollies that fit onto these kits perfectly. They load up into a truck, they ship them out to the property. And then when we close on a new deal, we have our own in-house team on site. And then they can open up that shipping crate and there's enough inventory for, say, the first 20 to 40 units or whatever it may be in that particular case. They can get started right away. They've got all the nails and screws and hardware, which cuts down on having to run to the local store back and forth. They've got all the hammers and tools and saws and everything like that. The only thing we really do locally as far as sourcing would be the heavy, bulky items like countertops and flooring and appliances and stuff like that. So bottom line is that we're saving 30% on material costs compared to many of our competitors by implementing this process. It increases the return on investment for our investors because that's a direct flow through to someone investing. And it's custom design, to us and our properties. If you go walk an Ashcroft Capital owned property, there's brand recognition there. We call all of our properties Halston or Elliott. So if you're in any of our markets and you want to visit our properties, look up Halston or Elliott, which would be Dallas and Orlando and Tampa, Jacksonville, Sarasota, Chapel Hill, North Carolina. And I always encourage that kind of stuff as director of investor development. But bottom line is we also increase turnaround time, turning a unit in 14 to 21 days max, sometimes sooner, just depends. That's a big improvement from what we did in years past. And there's a lot less environmental negative impact. When we're getting shower rods, for example, we're getting like 1,000 of those without the plastic and the styrofoam and the color packaging and all this crap, just the shower rods in a box shipped to us, because that's all you really need. So it's a great process. And so those are things to be aware of, both as I was hoping to add some value to both GPs thinking about maybe going vertically integrated or considering some of this stuff, and also LPs to recognize that, this type of value flows through to you, as an investor.
Yeah. Uh, I mean, it's when you said that, kind of about getting things custom made, I assumed automatically that you were going to talk about the big stuff, and cabinets and counter,
Oh
that
yeah,
kind of thing. And my first question in my head, I've been in construction a lot. I'm like, well, the cabinet configuration isn't going to be the same in every single property and all this. So I said,
yeah, not
but
the
I mean, what you're talking about makes so much sense. And we, when you turn over a unit, right? It's very easy to be like, oh, I'm just going to run to Home Depot and get the fan and the shower rod and the handles and all of those, because they're little things, and they don't, on their own, don't cost that much, sort of
sure,
subjectively. But when you're
yeah,
talking about doing this over hundreds or thousands of units,
right,
tens of thousands of units, like that is going to be a huge savings,
yeah,
which is amazing. Like, where do you said you guys had about $1 billion of assets under management before going vertically integrated.
right,
It seems like I always hear different, what do you think the right scale is to get vertically integrated? And I think there's, a couple of different things. You've talked about vertical integration of property management, construction management, and now this sort of procurement procedure. I would imagine there was a fairly substantial upfront cost in getting, especially the procurement part of things, in place, right? So
right.
there's probably some level of scale. Do you have a sense of when you think people should, like, at what level you should implement some of these things? Like, it sounds like a great idea in theory, but I
Yeah. Yeah,
it,
great points. A couple things I want to touch on. I'll answer that question first. Well, it's subjective. Obviously, like I said, I've
sure,
seen groups that right out of the gates, like, hey, we're vertically integrated. We do everything on our own. Okay. Others, wait like we did. So we just started to kind of sense that and feel that. Again, looking at metrics, like we were comprising 40% of our third party property management's portfolio. Well, that's a sizable client for them. You
mm,
know what I mean?
yeah,
And so when we're like, okay, we need more talent over here, and we need, we're buying this property, and then they have to go hire and train, and now we're getting new people on site and they're not being effective. You could just start to sense that we're going to have to do something. It reminds me of like Amazon's growing pains, with shipping, telling everybody same day, next day, 2 day shipping, and like
yeah,
maxing out the post office and UPS and saying, we have to do our own delivery trucks,
right,
like we
right,
just can't keep up. Much smaller version of that. But I want to give one more practical example before I forget it, on when you mentioned it adds up, small amounts add up. It's another factor to consider. We've acquired over 21,000 units. So just saving, $1, per
right,
unit on something tiny like a battery or something is $21,000. But here's something else to think about. Our light fixtures that we have custom made, we didn't just say, make us a cool custom made light fixture. They're LED, of course, for energy
mhm,
efficiency, but the glass often breaks on these lights, either by the resident or because the person installing it cracks it. Well, what do you do when you crack a light like that, right? You take it back or you go buy another one and you replace the whole light. Ours, we have parts for all of these components. So we have just the glass, for example. So if you crack the
yeah,
glass, replace the glass, right? It's 50 cents. It's not $20. And then we went down to one light bulb in each of these flush mount lights instead of two. Cuts down on, small savings, but again, it all adds up and it just makes the
yeah,
whole thing a little more efficient.
yeah. And I mean, that's when you get scale in a company, whether we're talking about real estate, or you brought the Amazon, Amazon has done a lot with their packaging, and it's like, it seems like a small thing to have slightly less thick cardboard on that package, but like,
Right.
but over scale, it's a tremendously big impact to them from a revenue standpoint, but also, like you mentioned, the environmental friendliness of not having all of the packaging associated. I've put in a lot of ceiling fans. There's a lot of packaging around those things, like, and to be able to reduce that on all of this, like, it makes a ton of sense, in terms of, like, at so many levels when you're really talking about it at scale. Um, I don't know if you can tell me this but the procurement procedure seems like something that is a business in and of itself that could potentially be marketed to other syndicators, managers, however you want to, who anybody else in the same space. Is
Yeah.
that something that you've thought about on the horizon? Again, if that's
Yeah.
proprietary information, it's fine. We can ignore that question. But it does seem like that would be something,
Yeah.
because I think it would be hard to put in place without the scale that you guys have, but super valuable. If you know what I
Yes.
mean?
Yep. All I can say to that point, and also to your point, is it's been discussed.
Yeah,
It's definitely been considered. So we'll see what happens in the coming years. But
yeah.
yeah,
It's a great, and I was actually had opportunity to hear Joe talk a little bit about that whole procurement process that you guys have in place now too. And it's to me, it's a brilliant strategy, and it's just being able to be at the point of being able to implement it, or someone should just create that company for syndicators and be, sort of a getting off track, but it's a really great idea. So I love it for a business model. um all right, we'll get back on track. So what do you say to people? You deal with investors all the time, and you're a limited partner yourself. What are you telling people? I know we've touched on some of it, but what's the message right now in mid 2024? We're there's a lot of positive
yeah,
thoughts on the horizon. You already mentioned we expect rates to come down. Who knows when exactly and how much, but there's a lot of, sort of positive on the horizon. So what are your main
yeah.
messages to people thinking about it?
Well, I like to, paint this picture with just a real example. I mean, we could talk forecasts and predictions all day, but as we've mentioned, nobody has the crystal ball. But hear me out on this. Well, all the new supply that's hitting the market right now is considered basically class A product, right? It's brand new
Mhm.
built, most of it's luxury and high end, yada yada. At the same time that we may be, peaking out on where cap rates have gone. So right now we're raising for and we're about to close on a class A property that was built in 2021 below replacement cost,
Mhm.
where, you know, 3 years ago, for the same price, the same dollars, we would have been buying a Class B 1985 apartment community that was going to be a relatively heavy lift and value add for us. So this is just a time to shift up. You can shift up in quality if you're going to be, switching up into A class stuff. We're typically B investors, historically speaking, taking like a B minus property to a B plus, but we're also selling to institutional players mostly, and institutional players love A class core assets. So this is just a great time, to think about a scenario like that. And maybe it's, and then on the sides, the things that were already discussed, which is dollar cost averaging anyway, just for the sake of doing that. And or if you don't subscribe to either of those philosophies, just buy the dip. When's the last time commercial real estate was 25% off? When's the next time it's going to be? And as we talked about, billions and billions coming back in specifically in 2024, it's going to be a very short lived window. Once rates start to taper down, investors start to get off the sidelines, more institutional start entering the market. Go back, if your listeners would do this, run a Google search on what happened to multifamily in the Great Recession as far as these valuation dips or income, any kind of metric you want to look at. What you'll see is a sharp decline through 2008 and 9. And by 2010, a rapid recovery. And by 2011, we're back to all time highs again. Okay. It's a
Yeah,
short window, right? As the saying goes, the bull takes the stairs, the bear jumps out the window. Very short lived. So this is just a moment in time that I just, a big reason I want to get on your podcast is just to put that word out. I don't want to be the person in a year from now saying, well, I wish I would have, spoke that out a little better to
yeah,
people. That's my true belief. I'm investing in these deals this year, just like I have in past years and will continue to do in future years.
yeah. And to that point, like call it a recession or not, whatever, some people insist it is, some people insist it isn't. But where we are right now in the market cycle, like, we don't expect this to last for 5 years, right? We
Hmm.
we don't, like, 5 years from now. And so the reality is that the if you're if you're looking at real estate as that long-term investment, which is what we should be looking at it as, then you're in right, just the right time, right? Because you're supposed to have time to wait. That's the idea. You shouldn't be thinking about it turning around in 2 years. That's just, it's where we were at to an extent, but again, that's it. We can look in very recent history and know that probably wasn't the right time to buy. It's you want to sort of buy when things are not at sort of all-time highs. So I think the message is very well received by me. What you're saying, it makes a lot of sense, and it's just kind of also just what we're seeing, and I think you will see, once people start jumping back in, I 100% agree, like, all of a sudden those values are going to go back up. And it's, you can even see it. I think you see it a little bit already here on, like, the single family side. In terms of certain markets, the rates have come down a tiny bit, and then
Hmm.
the sales start to get, listings go up, all of that. It's like it comes down a tiny bit and people jump. They're like, okay, I'm good now, I can do it. So it's just kind of it's really interesting to watch the psychology of it all.
Yeah,
um
I was listening to Barbara Cochran from the Shark Tank. She's a big real estate
yeah,
gal and had been through some market cycles in her lifetime.
yeah,
And she's like, "Do not wait for these rates to come down because, to your point, so many people are. We're talking about single family right now. Same is true though in the commercial space, I suppose. But she's like, if you wait for your mortgage to go from 7 to 6 to start shopping the market, the prices just bounce up, and
yeah,
like your payment ends up being approximately the same anyway, right? Because
yeah,
that $600,000 home is now 650, but you got a little bit lower interest rate, so your payment's relatively the same.
yeah,
So you can
yeah,
always refinance later too. So something to think about.
yeah. No, absolutely agree. Well, Travis, I know we talked about this before, but I think I can't skip the "what is your why" question on the Know Your Why podcast. So, and it's been a couple of years, so maybe you have some new focus in life or what. But what is your why? What's driving you now?
You know, my why relatively is the same it's always been, dating back to, we'll start at high school because I can give some practical examples starting at that point. Um, Academically, I never found myself to be very smart or an academic or by any means, but I had learned some things that really helped me academically, and so I ended up with this 4.0 GPA average. So I wrote a book for peers, and it was how to achieve a 4.0 GPA with minimal effort. So not the best title for a New York Times bestseller, but I didn't write it to make money. I didn't write it to get popular or make friends. I wrote it I actually gave it to an entrepreneurship teacher, a bulk of them. And I said, just, can you pass these out to different students that have an interest in it? I just wanted to help people because I had learned something that benefited me. And I was just trying to find an outlet on how to share it. I didn't know how to really share that information. And then fast forward, when I was doing the flips and was finding momentum and success early on with that, I wrote a book at that time, and I gave it to people I worked with, because I worked in oil and gas, and most of these people are not investors, generally speaking. And so when we get into conversation about hobbies and interests, real estate always came up, and then they would have questions. Can you mentor me, and can you teach me, how do I get started? So I just wrote a book to help them out. And so a couple of months ago, I just released Passive Investor Tips, which is the latest book. And it's basically from the podcast I ran with Joe Fairless on Best Ever for nearly 5 years. And I took kind of the best 50 episodes that were had the most comments, likes, feedback, interest, views. And I turned them into chapters, like actually handwriting out a book, not using AI. And that's kind of the latest thing that I've done to help people. And 100% of any profits go to the Best Ever brand, right? So I've done all this kind of stuff to answer your question in short, after giving the long explanation. I love helping people. I love giving my time back to others because I truly believe time is our most valuable asset. And you can always get more money. You can't get more time. And so trying to really help people better their own lives is a mission and a purpose of mine, and has long been that.
I feel like that title of the book you wrote in high school would 100% go viral on a social media post now. That's every social media post. It's like how to be amazing without any work, right? That's like everybody will
I had
click
it back
on it.
then.
Yeah, exactly. Yeah, you were well ahead of the curve on that. So amazing. How when people hear this, how can they reach out to you? What's the best way to connect?
Social media, passive investor tips is Instagram and Facebook, or Travis Watts on LinkedIn, Bigger Pockets, other platforms, or ashcroftcapital.com/Travis. And I've got some downloads on there and my calendar link if anyone wants to connect and have a Q&A call.
Awesome. And we'll put all of that in the show notes for people. Travis, this was great. I appreciate you coming back on the show anytime. Actually, maybe let's not wait years for the next time. Please come back anytime. I really enjoyed the conversation. I think people will get a ton of value out of this. I think that there's so much good information from. Really, I think you have a truly unique perspective as someone essentially a full-time passive investor, and so you've seen, deals, good deals, bad deals, all the in between. So I think it's a great perspective, and yeah, thank you for the time again today.
You, Brett. I appreciate you too, Jason. Thanks everybody for listening today.
Yeah, folks listening, I know you're going to love this one. Please like, rate, and review the show. Make sure you connect with Travis, and thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?